Forget all the talk about a New Year bull run. I'm not here to be popular. I'm here to try and save your portfolio. We're going to start this explainer with a number that should have every single investor paying very close attention.
$18.6 trillion. Now, this isn't some abstract government figure we're talking about. No, that number, that's the record-shattering total of U.S. household debt. We're talking mortgages, auto loans, credit cards, the whole shebang. It is the anchor weighing down this entire economy, and it's exactly why the smart money is already, very quietly, heading for the exits.
So let's just break this down for a second. The Fed's latest data shows the American consumer is standing right on the edge of a cliff. Total household debt, a record high. Credit card balances alone have blown past $1.2 trillion. You see, this debt binge, this is the cheap fuel that powered that market rally you saw. But here's the real kicker, the critical signal. 4.5% of all this debt is now delinquent, and that number's climbing fast. The party, my friends, is ending. This is a ticking time bomb, and the timer looks to be set for early 2026.
Okay, so with consumers this leveraged and delinquencies on the rise, who's actually paying attention to this? Well, the institutional investors are, the so-called smart money. And what they're doing right now speaks volumes, far louder than what the talking heads on TV are saying. The first major signal, the real canary in the coal mine, it actually came from the crypto markets. While a lot of retail investors were out there celebrating new highs, the biggest players in the game were quietly executing a massive sell-off. They were distributing their holdings. They were getting out.
Let's put a hard number on that exit. In December 2025 alone, Bitcoin whales, these are wallets holding over 1,000 Bitcoin, dumped $15 billion worth of their holdings. Now let me be clear. This isn't just taking a little profit off the table. This is a strategic exit before the door slams shut. This right here, this quote, perfectly illustrates the professional mindset. It's not about chasing the hype. The smartest players are actively de-risking. They see what's coming. They see the liquidity drain, that moment when the credit cards are finally maxed out and all the cheap money dries up, and they are getting out of the way now. They believe the top is already in.
But look, Bitcoin was just the first warning shot. What we're actually witnessing is something much, much larger. It's a systemic shift that analysts are starting to call the Great Reversion.
So what is the Great Reversion exactly? Well, it's a historic rotation of capital. It's a massive flight from overvalued paper assets, think tech stocks, and a move into undervalued hard assets. And the trigger for this? It's always the same. It follows periods of massive debt expansion, just like the one we're in right now, and it's often the prelude to a major economic downturn.
Let's make this really tangible. On one side, you've got your paper assets, tech stocks, all the AI hype. Their sky-high valuations aren't really based on future earnings. They're inflated by the cheap debt that's about to disappear. Then, on the other side, you have hard assets, gold, oil, commodities, things with real intrinsic value that don't depend on credit cycles to survive. The Great Reversion is simply capital fleeing from the left side of this chart to the right.
Now, if you think this is just a theory, look at this historical parallel. This chart shows the value of the S&P 500, but priced in ounces of gold. It's a classic way to measure just how detached paper assets have become from real value. And right now, that ratio is at a peak we haven't seen since the weeks just before the Great Crash of 1929. History doesn't repeat, but this is an echo that you simply cannot afford to ignore.
And this weakness we're seeing at home, well, it's not happening in a vacuum. It's actually being squeezed by a whole host of global risks, creating what some analysts are calling a geopolitical pincher.
Just look at the external threats closing in. Key supply chains are at risk because of growing instability in Latin America. The massive North American trade deal is facing a very contentious review, which creates a ton of uncertainty. And all the while, the U.S. federal deficit is just swelling completely out of control. Now, separately, these are problems, but together, they spring the trap.
So, we get to the crucial point. What do you do about all this? We've laid out the problem. Now let's talk strategy. A clear, actionable strategy for navigating what could be a brutal first quarter and a very difficult 2026. This is about survival.
And before you dismiss this as just being alarmist, just look at the data coming from the major institutions themselves. JP Morgan is now forecasting a 35% probability of a US or global recession in 2026. Now, when one of the biggest banks in the world puts the odds at 1 in 3, taking a defensive posture isn't just optional, it's absolutely essential.
So, here are 3 defensive steps to consider. First, respect the cycle. Don't be a hero trying to buy the dip too early. Analysts aren't even looking for a potential bottom until late 2026. Second, think about pivoting to real value, especially as institutions seem to be losing faith in the dollar. And third, and this is probably the most important, build a cash cushion. Holding 20–30% in cash isn't losing to inflation. No, it's buying you the power to act. It is the dry powder you'll need when high-quality assets go on a fire sale.
If there's one thing you take away from all this, let it be this. Asset prices often reflect liquidity that has already come and gone. The rally we all saw in 2025 was a ghost, and it was fueled by a consumer credit binge that is now coming to an end. The reality of 2026, the force that will define this next market cycle, is debt.
A quick disclaimer. This content is for educational purposes only and is not financial advice. Please do your own research and consult with a professional.